Okay.
For the first time in my life, I actually considered start filing bankruptcy. Like I was actually making interviews with Peter Francis Geraci and like all types of people to figure out like, hey, what should I do with this property? Because
Hmm.
I didn't want to keep pouring into it if it was going to just, it was a money pit.
Three. Welcome to House Rich, the real estate show. We talk to average people that have done above average things in real estate. Today we're going to talk with Eugene Marshall out of Chicago. So he teaches people how to build wealth through business ownership and real estate. So we're going to get into his journey, how we left his 9 to 5 through real estate, kind of some of his businesses. And so tell the folks a little bit about yourself, and thanks again for joining us.
Absolutely. I appreciate you for allowing me to share the platform with you here, man. So for those who don't know me, my name is Eugene Marshall, born and raised on the south side of Chicago. Kind of have that same average story of a black person that grew up on the south side of Chicago, single parent home. You know, parents lived check to check, didn't really have an understanding of building wealth or buying real estate or anything like that. I don't think my dad ever bought a home in his life. You know, he's been renting for forever. You know, and just had a desire to do something different, and also not to just, it wasn't just a desire, but it was a need. It was something that I felt like was very important for myself as well as for my future family. And started to educate myself as quickly as possible and start buying real estate and figuring out what it is do I have to do in order to create not just financial freedom but time freedom for myself, and
Mhm.
it's through business ownership and real estate. And so now I'm teaching folks how to essentially do the same thing that I'm doing, and not only that but pay it forward for other people that come behind them.
So what sparked that interest? Yeah, what sparked the interest? 'Cause like I say, you didn't have that foundation as far as for home life.
Yeah, okay. So I actually never shared this on a podcast before. So in high school, I used to steal.
All right.
I used to steal people's like iPhones and stuff like that because I went to Simeon where we didn't wear any uniform,
Okay.
and so we used to take people's phones and stuff like that and go sell them so that we can go buy clothes so that we wouldn't look bummy because I wasn't getting an allowance. I didn't
Hmm.
really have, my dad was on drugs, didn't really know my mom like that. Excuse me, I probably seen my mom probably a handful of times,
Okay.
maybe 10 times if I counted. And so I had to find a way to eat. I had to find a way to survive. And so that was my way of kind of like making sure that I still had something of my own. And so after growing, and a mentor of mine was like, yo, you got to go to college, even if you just go for a year, just go check it out, see what it's like, see if you like it. I
Uh-huh.
went there for a year and I was asking myself, what the hell do I got to do to never ever go back?
All right.
So I spent my whole from 14, no, from 13 to, 18, 13 to whenever I went to college, I slept on the couch, bed bugs. It was just like, I mean, the worst of the worst of the worst. And
Hmm.
so when I got to college, I finally felt free, no, I could finally sleep at night, bed
Uh-huh.
bugs not eating me up. And so I fast forward, I got, I was going to the barbershop to get my hair cut. And a buddy of mine was like, yo, like, I think you would really like this group chat, and it was a group chat about money and finance. And there was a lot of people in there that was in the city of Chicago. And so I jumped in there. And then one of my business partners now that I actually work with at the firm, Jeff Baidu, he kind of started the group. And it was people in there talking about finance or whatever. And they had a long list of books to read. Very
Uh-huh.
cliche story. I know a lot of people familiar with, that most people, once they read Rich Dad Poor Dad,
Uh-huh.
that kind of like gets them going. So same,
Yeah.
same thing here with me, man. I read Rich Dad Poor Dad. And when I read it, I was like, damn, this is literally describing my entire family. Like they just didn't really understand, the difference between assets and liabilities,
Uh-huh.
and so I read that book. As soon as I read that book, I just started figuring out like, yo, what the hell do I got to do? I read that book and I started reading more books and more books. And then that was kind of my start. That is what piqued my interest, I should say.
Gotcha. And then so how did you get into your first real estate deal to begin with?
Yeah, so a mentor of mine, he was kind of telling me, he was like, yo, you should buy a piece of real estate while you in college. So I was kind of going through the process while I was in college because I was working. I ended up landing a full-time job while I was still in school.
Okay.
So I had the W-2s and everything to show. And so I was going out there, I got a pre-approval, but the reality of it is that I wasn't ready, right? I was kind of premature, and I had to learn very early on that sometimes people may see something for you, but it's not the right time.
Yeah.
You know, you just gotta wait, and you gotta wait until you're ready, you know, to be able to take something like that on. So I'm glad I never did. But like my junior, senior year in college, I was like getting pre-approvals, whatever. Fast forward, I landed a job in tech, and I was studying the whole time. I had joined a network marketing group that taught real estate education.
Okay.
And so, you know, I got in there, I was networking, I learned how to analyze deals, you know, red flags, etc. And I was getting mentored by people that had, you know, 30 plus years in the game, you know, developers, flippers, wholesalers. And they was all telling me like, hey, you need to pick one lane, you know, study that lane and master that before you begin branching out into other things. And, you know, as most people, when they trying to get started in real estate, they want to go with the least path to resistance,
Yeah.
and that's wholesaling, right? So I tried the wholesaling thing. I've done a few wholesale deals, and then the state of Illinois kind of came out with the law that you can't do 2 or more, you know, wholesale deals within a 12-month period. Otherwise, you know, that's considered illegal, right?
Okay.
And you
You need like a license or to do it, or
yeah,
okay.
yeah. So you would need to get your broker's license essentially in order to do it. And even in that case, you're technically still not wholesaling because that still has to go through the managing broker,
Yeah.
you know,
Yeah.
for everything to get approved. So basically, what happened? So I started studying there, stacked up a bunch of dough right after I got out of college, and then I had connected with a broker. Fast forward past her, so I knew exactly where I wanted to buy. I had a few buddies of mine that had already invested in Woodlawn, which is the south side of Chicago. You know, a great area that was kind of turning around and gentrifying. You got the Obama Library that's breaking ground right now. They're digging that. You got Hyde Park. I mean, there's a lot of stuff happening. So I knew exactly where I wanted to buy, and so I bought a 3-flat FHA 203K loan. And
Okay.
when I
Okay.
bought the property, you know, it was 3 tenants already in the property. And so I had been listening to podcasts this whole time. And I was thinking like, all right, well, I can do cash for keys, right?
Okay.
Because I'm hearing on these podcasts is that, hey, look, if I just do cash for keys, you know, I could just pay these folks to get out.
Can you
And
break down what that is exactly, cash for keys?
yeah, so in layman's terms, cash for keys is nothing more, nothing less than saying, hey, squatter, hey, tenant that's not paying and or that's not upholding their end of the obligation in the tenant contract. Hey, I'm going to give you X amount of dollars to vacate,
Okay.
right? Hand over your keys, you know, get out of here. I'll pay for you to move. I'll do whatever it is that I need to do as the owner to essentially get access to my units. So that's all it is in layman's terms. It's just basically you just handing over some cash, a check, or whatever it is to help expedite somebody getting out of the unit. And so I was trying to do that, and I had learned very quickly that you know that's not it don't really work like that in all cases. And
It looks
so
good on paper.
yeah, it looks good and sounds good,
Uh-huh.
but with these 3 tenants that was in there, they hadn't paid rent in a year.
Okay. Oh
They
wow.
hadn't paid rent in a year, and the previous owner she was like 83 years old, and she just wanted to get rid of the property.
Is Illinois like a tenant friendly state? Or I mean, that's
No.
no.
Yes.
Okay. Okay. Okay.
Pro tenant for sure.
Uh-huh.
Definitely pro
Like
tenant.
yeah.
So that the first property was my headache property. I lost like $50,000 on that deal. And so all right, so let me kind of walk you through the story. So
All
a
right.
lot of people know me from that story.
All
So
right.
basically what happened was, and I don't want to be long-winded here, but I was trying to do the cash for keys, they wasn't paying, and so they wasn't going rather. And so I didn't want to displace them. I didn't want to just evict them, you know, young kid, just buying a property, you know, I'm trying to look out for everybody. So I started going to these centers that help with, you know, housing placement. And so I got all these resources and I would give it to them and I'll be like, hey, look, contact these places, contact these places. Like, you know, they have, you know, places where you can go that's affordable for you so that we don't have to go through the eviction process. So I did that for like 3 months. And I realized like, these people, they obviously not taking no action. So let me go ahead and start the eviction process now. While they're looking, let me go ahead and start the eviction process just in case they're not. Whole time they was not looking. I was just getting finessed. They was prolonging the
Yeah.
situation.
Free is the most affordable as far as I'm concerned.
Yeah, free is the most affordable. Exactly. So I was just getting finessed, man. And Chicago, the state of Illinois is a pro tenant state. First thing is, you know, you can't evict Not that anybody would want to. I can see why they would want to, but not to say that it's best to, depending on the where you're coming from, your place of heart. But obviously you can't evict in the state of Illinois, folks that know, in the wintertime.
Okay.
So you got to wait 6 months. You got to wait 6 months to get them out. So I started the eviction process in maybe October, November. I didn't get those folks out till April.
Wow. Okay.
So, and then I had a 2 or 3K loan, and the interest rate on a 2 or 3K loan is high. And I had a 6% interest rate at the time. Mm-hmm. So my mortgage was also high as well. Right. And I was like, all right, well, I'm paying this mortgage. I'm not living here. I can't actually get in there and renovate or do anything. So I was stuck with just paying my mortgage for 6 months, trying to get these motherfuckers out. Finally got them out. I'm gonna fast forward it. The contractor that I had screwed me over. He was a referral from a developer that I trusted, and the guy just did me bogus. He just wasn't doing stuff with the highest level of integrity, and I had to pay for my own education. The rehab stuff, a lot of stuff that you can kind of find online, but the actual renovation work itself, like a lot of that stuff, man, you just got to be in the trenches to truly understand exactly what's happening, because a lot of subs out there, they'll cut corners. You will be a victim of what you don't know. So I mean, it was.
Quick question about that. How much was the renovation? Like, did you have like a HUD consultant?
I had a HUD consultant, and that's the thing. I had a HUD consultant, and my HUD consultant was getting finessed too. Either my HUD consultant was getting finessed, or he was in on the thing. Literally, he was either getting finessed or he was in on the thing, because my HUD consultant would approve work that wasn't even complete. He would give him 100% payout on scope of work that wasn't even fully completed. Right. So you're supposed to have at least a 10%. You're supposed to hold back until the final draw, then you pay out everything. He was paying them out on line items, everything. I was like, all right, well, and then he wasn't accurately inspecting his line of work too. So I had to redo the plumbing. I had to redo the electrical. He was putting regular drywall in my bathrooms instead of green board in my bathrooms. It was just a lot of stuff that I had to learn the hard way that I didn't know going in. And I thought the game was sweet. And unfortunately, at that time, I bit off more than I can chew. And I lost about $50,000 on that deal.
Oh, okay. Wow. So, wow, 50,000. Okay. So $50,000 between the redoing the renovations and that's like no rents and all that. That was just kind of like the total, or just.
Yeah. So it's like $50,000 from, having to double back down for the renovations. It's the carrying the note. That's really it. It's just the renovation work and carrying the note.
Okay. And so to jump back to the beginning, like, so you said you basically, when you got out of college, you stacked up a bunch of dough to purchase this house. How'd you go about saving up like a bunch of money to begin with? Was it I'm just kind of worried about, I'm just interested in how you thought about the budgeting process, being a new college graduate. Most folks don't even think about that. They're trying to, get whatever, the nice car or whatever as soon as they get out of college.
Yeah. So thankfully for me, I was reading those books, right? I was already programming my mind. I tell folks all the time, like, you have to reprogram your mind. You don't just say, oh, I want to be wealthy, or, oh, I want to start a business, I want to do this. No, you literally have to train. It's like going to the gym. Just earlier today, I was listening to something that I bought, months back from Grant Cardone. So I'm always training. I'm always, reprogramming my mind, because I don't want to start drifting. I don't want to get lost. It's easy to do what's easy.
Yeah.
Right. But it's hard to do what's hard, if that makes sense. So I was saving dough. I had a mentor of mine. He was like, because he was already in the game. And I was like, yo, how do I get started? He was like, and I didn't listen to him. I learned this the hard way too. He was like, yo, if you want to get started in the space, he said, I would recommend for you to save at least 50,000.
Okay.
He was like, save at least 50,000, because you're going to have closing costs. And then if you never know what's going to happen with the property itself. There's a lot of upkeep and maintenance with managing real estate. And that's a part that a lot of, folks on social media don't actually show. They show that, oh, I just bought a 3-unit, 4-unit, or commercial, whatever, but they don't actually show, some folks do, but some don't. When the plumbing goes wrong, when there's a leak on the roof, you know what I'm saying? The stuff that just happened with home ownership. And so he was like, yo, just save 50 grand. I ended up saving like 40. And then I had another, I had some more money coming in from these other income sources that I was kind of involved, engaged with. But that was really where the thoughts came from. Like, yo, I need to start saving. It had somebody in my ear.
Okay. And how long between that, I guess you may call it a mini debacle or learning lesson, did you go say, hey, I want to purchase another property?
Well, so I guess honestly, for a while, I was depressed. When I went through that process, I was very depressed. I used to think that anxiety was fake. When people be like, oh, I got anxiety. I never could relate. I was just like, yo, anxiety, okay, like sure.
Yeah.
Until one night I was asleep. I had this sharp pain shoot through my arm. I thought I was having a heart attack. Went to the hospital, and the doctor said, hey man, you look perfectly fine. And they brought a psychologist in. They say, hey, look, you suffering from anxiety. And every time I went to the site where the work was being performed, I felt, I felt it. And I was like, all right, well, I gotta take a step back. So I started taking a step back from everything. And I even considered filing bankruptcy.
Okay.
For the first time in my life, I actually considered start filing bankruptcy. Like I was actually making interviews with Peter Francis Geraci and like all types of people to figure out like, hey, what should I do with this property? Because I didn't want to keep pouring into it if it was going to it was a money pit.
Yeah, yeah.
You know what I'm saying? It was a money pit. So fast forward, I took a step back and then I realized like, all right, well, this deal went wrong. I had a mentor came in and said, hey, we can fix this. It's not too late to fix this. And so I ended up hiring him to show me how to do it. He was going to do it himself, but I realized that people that don't pay attention.
Yeah, yeah.
And that's a principle that I stand on, that I live by. People who don't pay attention. So I actually paid him to show me, how to be a general contractor. He gave me all his subs, managed his subs, and then I actually started taking some of the money that I was getting from the renovation work, a little bit left that was there, that I had been building up, this nest egg of money that I was getting from this network marketing company. So I had a lot of dough coming in. It just seemed like everything was finally starting to work out for me. And so with the network marketing group, we taught real estate education as well. And I became a facilitator in our Chicago office. So I would be in front of a group of 30 to 40 people every Wednesday. And the majority of the people that were there were like twice my age. And so I started building relationships with those folks there. And I started realizing that, hey, a lot of these people that's coming to these meetings can be business partners. These can be people that I can leverage in order to get to where I'm trying to go and also help them get to where they're trying to go. So what I started doing was, folks that met my criteria in terms of, hey, they never bought a house before, they qualify for an FHA loan, right? They have the income to be able to get approved for, a good amount of a property that we can buy. I started partnering with them and I started providing the down payment. And the way I structured the deal was they didn't get 50% of the rent roll until I got my initial investment back. Right. And so that's how I structured everything. And I just started kind of scaling from there.
So how do you coordinate something like that? Because obviously you can't write into like the real estate contract itself. Like how do you coordinate that to make sure that you're actually they're actually meeting their financial obligation to you?
Yeah. So basically I'll just tell you how I did like the first deal. So we just created an operating agreement. We created an operating agreement and then I gave them the money. I put the money in the bank account that we both had co-ownership on way before they even started going through the pre-approval process. Typically what happens is, when folks start going through the pre-approval process or they get a house on the contract and then next thing you know, they get a large sum of money that come into their bank account, the lender is like, hey, what's this? You know what I'm saying? Hey, what's going on? Now you got to provide receipts. Somebody got to provide a statement, say this is a gift, all this extra shit. So in order to bypass all of that, I put the money in there first. Right? That way they had it before we even started any of that. So they had it there. And so we closed on a property. We created an operating agreement. We closed on a property. And then we quit claim deed the house into the LLC. And then from there, all the proceeds that went into the bank, I just took them off. I took them off. Essentially, we edited the articles of incorporation. I took them off. And then I got all the proceeds. And then once I got my initial investment back, I re-edited them in. And everything was safe. Everything was straight. It wasn't like I was dealing with folks that was trying to scam or do anything like that. But everything was completely laid out in the operating agreement that I had prepared by a real estate attorney.
Okay. And just for folks that don't know, like he was kind of saying, a hack per se, like your lender is only gonna look back at 60 days of bank statements. So if you got some money that you may not be able to source, just put it in the bank now, and they'll never see it essentially.
Exactly.
And so, just a quick question: the first house, do you still own that property, or did you get rid of it at some point?
No, I live there. I actually still live
Oh,
there.
it's
Yeah.
okay, okay,
Yeah.
okay. And then so you touched on it a little bit, but can you walk through the process of how to actually like purchase a home like in your business name? Because like I see folks talk about it, and like from my perspective as a traditional lender, that's not something I really dealt with at all. So how do you actually purchase a home in your business name?
Yeah. So first off, you can go to a hard money lender, right? When you go to a hard money lender, typically they're going to lend you the capital based on the asset itself,
Hmm.
right? So they want to understand, all of the numbers on the property, how much you're buying a property for, what's the fair market value on the property at the time of purchase, are there going to be any repairs associated with the property? They'll also give you the repair money as well. And then they also want to know what's the after repair value. What can we sell the property for, right? The ARV. And if the numbers make sense, every lender has their own criteria, that you have to, that property itself has to check out for in order for them to be able to finance you. And then some lenders, they may pull your personal credit, some may not,
Okay.
right? Some may just require for you to have a limited liability company established. That limited liability company may not or may need some form of credit history, right?
Okay.
It may not, or it may need some form of credit history, all depending on that particular lender. And then depending on the deal, that lender may require between 15 and 25% down in order for you to close, right, on the loan itself. So the process is relatively is not easy, but it's simple as long as you meet the qualification that's set by that particular lender. And then from there, you can select, a title company and everything like that. Of course, if everything goes well with the contract and you can get everything, essentially established, you go ahead and send everything back over to the lender. You select a title company of your choice. Of course, if the lender actually approves the funding, then you go ahead and close.
Okay, thank you. And so in the situation where they're pulling like your personal credit, are you like a personal guarantor? I'm messing up the word, but does that reflect on your personal credit at all, or they're just basically checking you out essentially?
Yeah, so the inquiry does.
Okay, but not the monthly debt. That's not in your personal credit?
No,
Okay. Okay.
that's on the business. But the inquiry shows up, but the actual debt itself is on the business.
Oh, that's a good point. That's one thing I've always been curious about is like what outside of like the liability issue. I never understood what the point of putting something in your LLC was. But okay, so basically you can stack a bunch of properties in LLC in that LLC, and it won't affect your personal DTI at all for your personal credit at all.
Exactly.
Okay.
Exactly. So that's the purpose of you actually creating the entity,
Mhm.
right? So you can separate yourself from the entity and also minimize any personal liability that may be associated with you having these assets as well. And that's why a lot of folks, they actually close inside of a land trust, and then they have the beneficiary of the land trust be a limited liability company. So they get what you call both inside and outside protection. And the whole goal there is to minimize any personal liability that you may have and or may be exposed to with that particular asset.
Like what's a land trust?
So a land trust is nothing more, nothing less, but a legal parameter that allows for an individual to transition down assets to someone else, right? It's just a
Okay.
legal document that separates you from the actual asset itself,
Oh, okay. Okay. Thank you.
specifically for real estate. So you
Uh,
got other types of trusts as well,
mhm.
irrevocable living trust, revocable living trust, and then you got land trusts that are particularly for real estate investments.
Oh, okay. Okay. Thank you. And with the LLCs, is there a like a is there any sort of like max LLCs you can have, or can the hard money lender see how many LLCs you have? Does that factor into their decision process?
So they can ask you whatever they want, right? So
Okay.
every lender has their own requirements.
Okay.
If a particular lender says, hey, what other companies that you may have, they may be exposed to any other things, they may have a risk on what we're doing here, they may ask for that.
Okay.
So it really just depends on what that personal or what that, that lender is requiring personally.
Okay, okay, gotcha. So it depends essentially. Okay, thank you for that. So I want to kind of jump into the business you have as well as far as the tax side. You do kind of do taxes. We help like real estate professionals. Like what are some and this is a very generic question or general question, but like what are some tax tips or tax benefits that are kind of associated with real estate or that you may help some of your clients with?
Yeah, buy real estate every year.
Okay.
I tell folks all the time, buy real estate every single year, right? And so there's one strategy called cost segregation, right? That essentially allows you to accelerate the depreciation of that asset by 25% within the first year.
Okay.
So let give you an example here. So let's say, you got a business, ABC business makes $1, right?
Uh-huh.
The IRS going to want their fair share of that dollar. So the IRS says, hey, David, we want a quarter, right? We want a quarter. So David gets smart and say, hey, I want to keep my quarter.
Uh-huh.
I want to keep my quarter. So what David does, David decides that, hey, you know what? I'm going to go buy a piece of real estate. The bank typically gives you a 3-for-1 match on your money. So if you understand that, then that says that, okay, if I got $1, I can go buy a property that's worth $4, right? I can go buy a property that's worth $4, and then I can use that dollar as a down payment on that property, right?
Uh-huh.
And then within the first year, you can accelerate the depreciation on that property by 25%. What's 25% of $4?
25 cents for $1, $1. I
That's
get
the
that right. Okay.
that's the same dollar
Okay,
that the
gotcha, gotcha.
IRS is
Okay.
going to that the IRS is going to tax you on. They no longer can tax you on because now you have a depreciated asset that gave you a negative number. And
Gotcha,
so
gotcha.
what a lot of folks, and this is actually very interesting. I'm glad that you brought this up. So in this day and age, you got people talking about, well, not talking about, they are, but they're in love with the term, tax write-off and
Yeah,
business owner.
yeah.
And so what they think is, hey, I'm gonna start this business, I'm gonna make money in this business, and then I'm gonna go and write everything off. Right. And when they go do that and they try to go get some form of lending, some form of capital injection from the bank saying, unfortunately, Eugene, your business is not as profitable as you may think
Hmm.
because you don't wrote everything off.
Yeah,
But with depreciation, the lender adds that back.
yeah,
The
yeah.
lender knows to add that back to your buying power. And so that's why folks should be buying real estate every single year, because real estate allows you to be able to, leverage cost segregation to give you that negative number instead of you having to write everything off and you showing that your business is not profitable. So those are some of the things that we kind of teach in a bit more strategic manner in a service called tax planning that we have a lot of clients enrolled in.
Okay, okay. Yeah, that's an interesting point because yeah, I think about it when I look at folks' tax return, everything is written off except for I think if you're like a Schedule C employee, I think it's like box 12B. It's like a depreciation goes right back into income, goes right back into your income for some reason. I'm not quite sure why that one gets added back and everything else, but yeah, yeah, yeah. If you're because I see a lot of times, as you mentioned, business owners will have everything written off under the sun because their CPA's job was they haven't paid no taxes, and now that's great, but now they can't finance anything. So it's the double-edged sword of writing your life off.
I
Could you?
tell folks, let me add this in there. I tell folks all the time, whenever you're going out there sourcing a CPA, the number one question is, how can I maximize my deductions while also looking profitable on paper?
Okay.
Right? How do I maximize my deductions while also looking profitable on paper? If they can't answer that question for you, then you're probably in the wrong spot.
Okay. So how does one do that in general? Let's just say I'm a say I'm a I don't know, I own a whatever example you probably want to give better than me, but how do you go about maximizing your profit but writing off what you can just in general?
Yeah, first things first, you gotta have a business that's generating income.
Okay.
You know, you got to have a business out there that has a demand for a product. It has to have a demand for a service, and you understand that there's a need. Your business have to serve a need, something. So we got to start there first, right?
Hmm.
So once the business is actually generating income, okay, cool. Now with all businesses, you're gonna have, business expenses, right? You may need to travel someplace to a conference to actually, promote the business to get the brand out there, right? So your travel cost is deductible. right? You may need to meet with a client at lunch to talk about, hey, here's how we can get you approved for X, Y, Z. That particular meeting is deductible, right? So it's really connecting with the right folks that truly understand what's deductible and what's not, and at what percentage, right? Because everything is not 100% deductible either, right? So it's really understanding that whole concept, of, hey, how do I maximize my deductions? One, make sure I got a profitable business. Two, making sure that, hey, the things that I'm actually spending my money on in the business is also paying the business forward.
Okay.
Right. It's also paying the business forward. And then three, now we start implementing real estate. We start
Okay.
putting real estate in the mix. And then we just kind of start going down the rabbit hole from there.
Okay. And what exactly is a tax write-off in a sense or two? Because like I said, everyone says everything is a write-off. It doesn't really make any sense to me. But
Yeah, so a tax write-off is nothing more, nothing less but a qualified business expense.
okay.
It's nothing more, nothing less but a qualified business expense. And I see folks saying this all the time, like, oh, I'm going to write this off and I'm going to get this money back I'm going to get this money back. They'll say something like, I'm going to write this off, so it's basically free.
Yeah, yeah.
No, it's not free, bro. It's not free. So it's like, that's not free. Like you're actually spending money right now. There's not free. All it's doing is nothing less but lowering your taxable income. So if I made $1 in my business, but I got 50 cents worth of qualified business deductions, then the IRS is not going to do nothing more, nothing less, but tax me on that 50% that's remaining.
Yeah, yeah.
Right. That's all they're going to do. So that's essentially what a write-off is. It's nothing more, nothing less but a qualified, business deduction.
Yeah, the internet will have you think, like I said, you can buy a G-Wagon and Uncle Sam will just pay you to ride around in it for no particular reason. Yeah.
Dude, I honestly, it kills me when I see those reels, man. Like, oh, this is that. If I don't know what they be saying, I be seeing it, but
Yeah,
they be like, oh, buy you a G-Wagon and do all this and do all this. Man, first off, you skipping a lot of steps, fam. Like, we haven't even talked about like marketing and advertising.
yeah.
We haven't even talked about, having a client system, or having, what I'm saying, like, none of that shit. And I think what they really be doing is actually setting up folks for failure, and just kind of giving them part of the process without actually telling them, like, hey, here's what you got to do to even get there. That's like step Z.
Yeah.
Getting a G-Wagon is like the last thing that you do. You know what I'm saying? Like, you got a whole lot of stuff that you need to be doing in between. So
And I saw in your profile on your Instagram page, you had this blurb about being your own bank. You kind of
yeah,
explain that concept.
absolutely. So I'm glad you brought that up. So that's probably what I should have said we should talk about.
All right.
So all right. So basically, when I looked at it today, I checked today. Inflation was inflation, they announced 8.4%.
Yeah.
8.4%, right? The national average for annual percentage yields for banks is at 0.07% for checking accounts, right? At best, in a high yield savings account, you may get, 1 or 1.9%, depending on who you with, et cetera, et cetera, et cetera. So the whole thought process of becoming your own bank is trying to figure out, hey, how can I park my money into an investment vehicle that can build cash flow for me, cash value for me, that can outbeat or hedge against at least inflation, right? So when we start talking about things that can build cash value, we're talking about, in this case, I'm talking about life insurance policies. Okay. So a lot of folks don't know that they can actually leverage life insurance policies while they're alive to build more wealth. Like I think it's Chris Crone. So Chris Crone he in real estate.
Okay.
He talks about all the time, how he borrows from his life insurance policies to go out there and buy commercial and do like large developments. And a lot of folks actually, you kind of skip this boat. So basically, you got whole life policies, average whole life policies grow between 4 to 6%, right? And then you got 20 pays, you got 65 pays. And when I say 20 pay, I'm talking about, hey, you pay on this until age 20. When I say 65 pay, you pay on it to age 65. And then of course you got forever, where you pay on it until forever, until you pass away. And then you have index universal life insurance policies that allow you to get essentially a 15% return on your money. right? And so it now puts you at an advantage to outbeat inflation rather than going with a whole life policy where you're going to get 4 to 6%. You can actually get 15% return investing into an index such as the S&P 500, and whoever this person is that gets the policy, they can actually do that. They can actually choose what index they want the contributions to get invested to. And then you have what you call the floor. And so the floor is 0%. So at bare minimum, if let's just say the S&P tanks, the S&P did 26.89% last year. If the S&P tanks, then at the bare minimum, I have a floor at 0%. I'm not going to lose any money, right?
Okay.
So when we start talking about becoming your own bank, they're saying, hey, let's leverage life insurance policies where I can build cash value and capture a 15% annual rate of return on my contributions that's being invested, as well as get a death benefit that's associated with that as well. And I tell folks all the time, like, the least selfish thing that you can do is go out there and get a life insurance policies. If you truly want to build wealth, that's the easiest thing to do is go out there and get you a life insurance policy, whether it's whole life, whether it's an IUL, a VUL. I'm not that big of an advocate of term, but do whatever you got to do to get some type of coverage in yourself. And a lot of us, we have, now I'm going down a rabbit hole. A lot of us, we have, insurance on our phones, right? We have insurance, we have renters insurance, we have insurance on our cars, but not, then some of us have insurance on our life, not as much of us. I'm still seeing GoFundMe's going around, especially in the Black community, but not many of us have actual insurance on our income. Right. And I feel like the pandemic should have taught everybody that nobody's safe. Right. There's no such thing as job security. It does not exist. Right. Millions and millions of people were laid off due to COVID. And if you kept your job, and if you're listening to this podcast, you need to be very, very thankful that, you were able to keep some form of income coming in, during that crisis. So I think if folks start to really understand that one income is too close to none, they have to begin critically thinking about how they can actually leverage their money to go out there and create more money babies for them.
Okay, thank you. Let me see if I understand the concept in general. So I'm just gonna say life insurance in general. But so I have a life insurance policy. Let's say it's for $100,000, and I pay $200 a month into this policy. Can I can borrow against the policy right away and then invest it into the market, or it has to hit a certain number, or?
Yeah. So with an IUL, right? So your contributions, let's say you got $1,000. Let's say you're putting in $1,000 a month into a policy. So 90% of that is going to go towards the actual investment side of the house. So that's going to go into the S&P 500. We just choose the index. It's the easy index to choose right now. And then the other 10% is going to actually go to cover the actual cost of insurance, right? To actually keep the policy in place. So what I do want to make sure that everybody know as well is that with life insurance, life insurance is not one of those get rich quick thing. You could just put your money in there and then you can automatically pull it out and then you're good to go. No, right? It's almost like cooking a cake, right? You got to get your ingredients. You got to put it in the oven. You got to let it rise. You got to let things settle. It's the same way, right? And so what a lot of folks think is they say, okay, I'm only going to do this for about 5 years. And then they take all the money out. But then if they take all the money out, now there's not enough cash value in the policy to actually pay for the policy itself. And then now that policy is potentially on the verge of essentially lapsing, right? So you want to make sure that you do whatever you're contributing to the policy, that it's a long-term investment. You're not putting into the policy $200 for a year or $1,000 for a year with the goal to take it out right away. It's probably not even going to be enough in there for you to do anything substantial. If you have an emergency, of course, you can go ahead and you can take the money out. And when I say take the money out, I'm talking about borrowing against the policy, right? You don't want to go in there and just get a withdrawal. You want to actually borrow against the policy, because when you take a loan from the policy, that's tax-free. Right? That's a non-taxable event.
Oh, okay. Thank you. And so I know you got out in a little bit. So wish I'd asked this question a little bit earlier. I got a bunch of questions about this topic, but I want to jump on the last question I always ask folks. If you had So let's say I give you $1 million. You have a week to spend it on real estate related or real estate adjacent items. What would you spend it on?
If I had $1 million and I got to spend it in a week and I got to spend it on real estate adjacent items,
Yeah.
man, I'll go out there and buy the biggest property the biggest property that I can afford with a $500,000 that, well, I got to put everything on real estate. So, I mean, I just buy cash flow, man. I would buy the property that I don't have to do no work. You know, I don't want to do no work. You know, if it's already turnkey ready, I take that $1 million, I leverage that whole fucking million and buy a property that cash flow, whatever makes sense for me to
Gotcha.
put down a down payment of $1 million. That's what I do.
Okay. Okay. Cool. Thank you. And so, like I said, some of these topics we can get a little bit, or not we, but he can get a little bit more in depth with. You talk to folks about, where they can find you, some of your courses, et cetera, so they can dive a little bit more into these topics.
Absolutely. So if you have the desire to actually become your own general contractor and renovate houses, you can go to therenogame.com, where I put essentially my blueprint there on how I got started in the renovation space, how I became a general contractor. Even if you don't want to become a general contractor and you're looking to hire a general contractor, I teach you what to look out for. Right. You want to make sure that whoever you're screening, that they have some job site that you can go by. And when you go by their job site, you want to see what the atmosphere is like. Right. You want to make sure it's clean. You know what I'm saying? If they have a dirty site, then the likelihood of your site being dirty is going to be the same. Right. So there's a lot of other different things that we got to pay attention to when we actually start talking about, hey, I want to get started in real estate. You know, what's the best way to get started? I teach you how to analyze deals. I teach you how to source those deals. And I also teach you how to get $200,000 plus in capital funding that you can leverage and use so that you can go out there and buy more real estate. Right. So the name, and a lot of people say, hey, I want to get started, but I don't have the money.
Mhm.
Well, I wouldn't say that I don't have the money. You just don't have the education, because the money is out there, especially if it's the right deal. Right. If the deal makes sense, you can always find the money, but you can't find the money if you don't even know where to start looking. So you can find it at therenogame.com. And then my social media is at __ Mr. Marshall. You can DM me the word wealth, and then I'll get back to you as quickly as I can.
Okay. Awesome. It's like all the information will be, whether you're watching on YouTube, listen to the podcast, it'll all be in the description for this episode. So, yeah, once again, appreciate you. Appreciate the time, the knowledge, everything you enlightened me and the listeners with. And there is no outro to this podcast, so it is now over.